Hey guys, I want to talk about what has worked, and then I want to use an example of, like I said, one of the companies that that I had bought at 350 a share, and I had like 1,500 shares, and it ended up going to $100. But I had sold early, but the potential was for 5,000 to turn into 150,000. Of course, you still got to pay taxes on that money. But what has worked as far as a value investor has been low PE, low price to book. But like I said, a lot of these companies, you got to do your research. You got to. Some of them might be value traps. Some of them might be fraudulent. Some of them might be worthless. So maybe the business is sorry, and the business is dying, or a new technology is putting it out of business. But I don't know. This is more complicated, but there's something called earnings power value. Like for an example, is Coca-Cola, where the value of the company might be here, but the earnings power value might be out here. Anyway, the reason why the low PE, the low price to book for value investing, why it works, is like when I had chose DAC, for example. I looked at the worst companies over the last 5 years or so, and there was articles, there was news articles, the worst companies to buy. This was like number one on the worst companies to buy, and like I said, that's why I started doing research. I thought it was worth $2 billion and had a billion in debt. I thought it was worth $1 billion. Was selling for $100 million. So that I thought I had a 10x possibility over the next 5 years. So the question of a bird in the hand and a bird in the bush. And how many birds are in the bush? How sure are you? And how long is it going to take you to get there? 2 years, 3 years, 5 years, 10 years, 20 years? Let me just go back to this example. And the company today is valued at a little over $1 billion, and it's fallen quite a bit from the. If you bought at 100, you're down half. But the PE, and I don't take these numbers with a grain of salt. The PE is 2, which in theory, means you get you pay $2 today to earn $1 1 year later, and you get your money back in 2 years, and everything into the future is profit. And the earnings per share is a whopping almost $30, plus you're getting a $3 dividend a year, which is about a little over 5%. just looking at a stock screen, let's just say, and the market, like I said, has been down this year. Sometimes you might do a search like this and you won't find anything. You won't find anything. You put like one or two companies, and like there's 11 pages. I don't want to go through 11 pages of stuff. So you can play with the stuff, and if you like bigger companies, you can change the market cap. If you want dividends, you can do that. If you want only U.S. companies, you can do that. You can search by industry. There's all kinds of things that you can do to narrow it down and to get a more manageable, instead of 100. 100 companies, 200 companies. That's a lot to go through. But you want to knock it down to maybe pick 5 or 10 or maybe just a couple. And but what is interesting, when I just did this little generic search, and like I said, I don't own this company now. That was the one I could have made a lot of money on. I did make some money on it, but I could have made a lot more. But it's right here. It was a shipping company in Greece. Like I said, I like the foreign companies over the U.S. because they're usually cheaper. But then there's valuation, and then you can look, and this means PE. This is the current PE. This is the forward PE, the PEG ratio, price to sales, price to book, price to cash, price to free cash flow, earnings per share this year, earnings per share next year, the price. How much one share today costs, $54.33. And then you can go to a website like this, where Guru Focus, and I like no analyst coverage. You know why? Because that means I'm competing against less people. If the biggest hedge funds in the world have 100 different people looking at Apple, well, to me, maybe Apple's fairly priced or whatever. I'm not going to find a big difference a lot of times. But when you look at these smaller cap companies, these companies that are ugly, these companies that are boring, these companies with low volume, a lot of times they've been forgotten about, and nobody cares about them. And now this is good, like they had a lot of debt, and then they're like paying the debt down. But what I like about this site is I don't know what this GF means, but this has the value ranking, the growth rate, profitability, financial strength, momentum. This is possible value trap, think twice. But this is, this is the earnings power value. Like I said, a lot of times the earnings power sometimes can be higher than the stock price. The net current asset value is negative. The tangible book value, 125. Projected free cash flow, 211. The Graham number and the Peter Lynch value. Now, Graham and Peter Lynch were two very good investors. So if this is correct, and the stock's really worth $358, you can get it for $54. That would be a bargain. But I like to look at this just for a grain of salt, and they got all these numbers like well above what the price is. So that tells me, this company, might need another look. Because it does look cheap. Uh, you can go to filings, go to company filing searches, type in the company's name, and then since this is a foreign company, it's a little different than the U.S. But I believe this is the annual, and it just, this is kind of boring to read through all this stuff, but if you own the company, it's worth reading. It tells you like what ships they own, how many, how big they are, how many small ones, how many big ones they got. But somewhere on here, you got like the income and basic earnings, diluted earnings, dividends, and you got to look up here like in it's in thousands. $260 million increase in revenue. During the COVID stuff, all the shipping prices went through the roof. But anyway, this is just like an example of how I do my research and how I pick stocks. You might start out something generic like this, and then maybe you don't like penny stocks, and you want something that's over $50 a share, and maybe you want big companies, and maybe you want just the U.S. and so it. A lot of times, like you said, if the more stringent your criteria is, the less companies you're going to have that pop up. But yeah, this is like a starting point, and like I said, I like this site just so I can see, all right, they're showing this thing's cheap. Well, maybe this thing really is cheap. Maybe it is a bargain. And I think one reason this company, I didn't really look any more into the details of why it really went to 100, but I know they had a big stake in another stock that had taken off, and I can't remember what it was, but that was the main reason why it had gone up, because you might have a company and they invest in other companies. If they believe they can get a better return, if they invest $1 in another company and get $5, that might be a wise investment for them. So sometimes other companies invest in other companies and take on ownership in other companies, and sometimes they have a plan of eventually buying them out or whatever. But I don't know what all these things mean, but return on investment, return on assets, on and on and on, any kind of like statistic you want, it's here. And then they have all these, you get to see who owns it. And anyway, thank you.